This is BD Daily Finance News Podcast, your home for daily insights on markets, the economy, and investing. Welcome to the Beyond Daily Finance Show for Thursday, December 11th, 2025.
And I'm your guest. Today we've got the Fed cutting rates again, stocks freaking out about AI bills, crypto doing its usual roller coaster, and a Walmart worker who somehow retires with $2 million.
On the menu, the latest 25 basis point Fed cut and what it means for your loans and savings. Oracle's AI spending spree and the market jitters. A sharp crypto pullback that wiped out hundreds of millions in bullish bets. And the habits behind that Walmart Millionaire story.
We're going to explain why your mortgage rate might move, your crypto bag is crying, and your grandma's boring savings plan might still be winning.
Let's start with the big one. The Federal Reserve just cut interest rates by 25 basis points, bringing the target range down to roughly 3.50 to 3.75%, in line with what markets were expecting.
So that's the third cut this year, after a pretty divided Fed meeting, right? Even the people who literally set the price of money are arguing about it now.
Exactly. Some officials worry about cutting too fast and reigniting inflation. Others worry about growth slowing too much. Think of it like driving on a wet highway. They're tapping the brakes, not slamming them, trying not to spin the economy out.
And the market was basically like, cool, thanks for the 25 basis points. But also, can you promise us 10 more cuts and a back massage in 2026?
Right. The Fed's projections, the so-called dot plot, suggest fewer cuts ahead than traders had priced in. So we got a cut, but not a full-on pivot party. That's why you're seeing some of the post-Fed rally in stocks and crypto fade.
Okay, let's do the part everyone actually cares about. If I'm a normal human with bills, what does this cut mean? Is my mortgage magically cheaper, or do I just get 3 extra cents of interest on my savings?
If you have a fixed-rate mortgage, nothing moves immediately. If you're shopping for a new one, lower Fed rates usually nudge long-term yields down over time, which can mean slightly better offers. Adjustable-rate mortgages and home equity lines tied to short-term rates will feel the change faster.
So if my rate adjusts, I might see my monthly payment drop a little, like the bank finally buying me half a coffee each month.
On credit cards and other variable-rate debt, the impact is clearer. Many cards are priced off the prime rate, which moves with the Fed. A 25 basis point cut is 0.25%. On $10,000 of revolving balance, that's about $25 a year less in interest if your rate fully adjusts.
So still not free money. It's like the Fed is saying, we'll make your debt slightly less terrible, but you still have to stop swiping like it's a sport.
Exactly. And on the savings side, banks may trim yields on high-yield savings and CDs over the coming months. If you locked in longer-term CDs before this cut, you look smart. If not, it's a reminder that those 5% savings accounts were not forever.
So action step here. If you've got high-interest credit card debt, use this window to attack it. And if your savings rate just got cut, shop around instead of just complaining to your group chat.
Market-wise, we saw a relief rally right after the Fed move, but it didn't last. The NASDAQ 100's post-FOMC gains were quickly wiped out as investors digested the message and other headlines hit, especially around AI spending and U.S.-China tensions.
So classic. Markets hear rate cut, throw a party, then read the fine print and realize it's more like a polite brunch with limits.
Which brings us to Oracle. The company posted mixed earnings. They beat on earnings per share and talked up a growing AI deal pipeline, but revenue disappointed, and they raised their data center capital spending plan by about $15 billion.
And the market's response was basically, wait, you're spending how much to host everyone's AI homework? Oracle stock dropped around double digits in early trading and dragged other AI names with it.
Investors are nervous that AI infrastructure is becoming a very expensive arms race. Think of Oracle building massive digital warehouses for AI. If those warehouses stay full and profitable, great. If demand slows or pricing pressure hits, you're left with a huge bill and less profit.
So it's like signing a 30-year lease on a giant office because you assume all your friends will pay you rent forever. If even a few move out, suddenly you're the proud owner of a very expensive empty vibe.
Exactly. That's why Oracle's $15 billion bump in data center spending revived AI bubble fears. You saw Oracle shares slide, and that weakness spilled over into Nvidia, Microsoft, and other AI-linked names. Investors are asking whether AI profits are keeping up with AI capex.
And this is on top of other headlines, like concerns about smuggled NVIDIA chips and geopolitics, which already had people side-eyeing the AI trade. Oracle just added a big neon sign that says, "This is getting expensive."
For everyday investors, the lesson is simple. AI is a long-term theme, but the stocks are sensitive to spending cycles. If you own AI names, know whether you're holding for 10-plus years of structural growth or trying to trade short-term hype. Those are very different risk profiles.
And maybe don't build your retirement plan on the assumption that every AI company will print money forever. Some will win, some will overbuild, and some will become the MySpace of machine learning.
Speaking of volatility, let's talk crypto. After the Fed cut, Bitcoin briefly broke higher, but then we saw a sharp reversal. A broad crypto top wiped out roughly $370 million in bullish bets as Bitcoin and Ether gave back gains, and coins like Solana and Dogecoin slid.
So basically, people piled into leveraged long positions, assumed the Fed would bless infinite risk on, and then got margin called by reality.
Exactly. Crypto is like the economy's drama queen. When the Fed hints at easier policy, traders rush in with leverage. When the message is more cautious or risk sentiment sours, those leveraged positions get liquidated fast, amplifying the move down.
It's like stacking Jenga blocks on a wobbly table. One little shake and the whole tower of leverage collapses, and everyone pretends they always knew it was risky.
For normal people, the takeaway is not never touch crypto. It's treat it like a speculative satellite, not the core of your portfolio. No leverage, size small, and assume you can wake up to 20% swings in both directions without warning.
And don't tie your rent money to Bitcoin's mood. If a $370 million wipeout in longs makes you nervous, that's the point. This is not a savings account. It's a high-speed roller coaster.
Now, let's balance the drama with something calmer. There's a story making the rounds about a Taiwanese immigrant who worked at Walmart for near minimum wage, retired at 87, and reportedly had about $2 million in assets, including 2 houses.
So while everyone else is trying to get rich off leveraged crypto and AI hype, this person quietly played the long game, clocked in at Walmart, and ended up with millionaire status.
From what's been reported, the secret wasn't a magic stock pick. It was classic wealth building, living below her means, buying property, holding for decades, and consistently saving and investing small amounts over a very long working life.
So the strategy was basically be boring, be patient, and don't blow your paycheck on stuff you forget you bought. Wild concept.
If you run the math, it checks out. Even modest monthly contributions into broad stock index funds, compounded at, say, 7% annually over 50 or 60 years, can reach 7-figure territory. Add real estate in appreciating markets, and $2 million becomes very plausible.
Meanwhile, most of us want 7-figure results with 7-day patience. We'll research the perfect crypto meme coin, but not set up an automatic transfer to an index fund.
The lesson here is that time and consistency can beat income level. You don't need to be a tech founder to build wealth. You do need a solid savings rate relative to your income, basic diversification, and the discipline not to raid your investments every time there's a shiny new trend.
And yeah, working until 87 is extreme, but the core habits are copy and paste. Live a notch below your means, own assets that grow, and let compounding do the flexing instead of your lifestyle.
Let's tie this all together. The Fed cut tells you to review your debt and savings, refinance or pay down high-rate balances where you can, and be ready for savings yields to drift lower. Oracle and the AI jitters remind you not to overpay for hype without understanding the cash flows.
Crypto's $370 million liquidation day is your friendly reminder that leverage is a terrible roommate. And the Walmart Millionaire shows that you can quietly beat all that noise with boring, repeatable habits.
If you want a practical checklist from today, 1. List your debts by interest rate and attack the highest first. 2. Check what your savings account is paying and switch if it's far below market. 3. Make sure your portfolio isn't accidentally a pure AI or pure crypto bet.
And 4. Set up an automatic monthly investment into a broad index fund, even if it's tiny. Future you would like to personally thank Walmart Millionaire you.
We'll leave it there for today. This was BD Daily Finance News Podcast, the Beyond Daily Finance Show, helping you make sense of markets, the economy, and your money.
If this helped you decode the Fed, AI, and crypto chaos, hit subscribe, tap like, and drop a comment with the one money habit you want to fix before the next rate decision.
New episodes drop daily, so turn on notifications and we'll be back tomorrow with more market moves and real-life takeaways. Thanks for listening.